Hello and welcome back to NOVARISE, to another video. And today we're going to talk about mortgages. Let me introduce you to Fannie Mae and Freddie Mac. These may sound like the perfect names for a funny couple, but in reality, these are two agencies that guarantee a secure and liquid mortgage market. The Federal National Mortgage Association, known today as Fannie Mae, was created back in 1938 by the U.S. government when home ownership was unattainable for most Americans. Its main goal was to ensure affordable and reliable mortgages throughout the country. And it worked. In fact, Fannie Mae's efficiency led to the creation of the Federal Home Loan Mortgage Corporation, popularly known as Freddie Mac. Fannie Mae and Freddie Mac are the core blocks of the whole American housing market. Together, they guarantee over 70% of all mortgages, but you, as a borrower, don't even interact with them. So how does it work then? Let's say there's a lender, a bank, credit union, etc., which gives you a loan, but banks don't have enough liquidity to keep lending to everyone. So to make housing more accessible, the U.S. government created two corporations, Fannie Mae and Freddie Mac. What they do is basically buy the loans that lenders give to Americans. They keep some of them, but the majority of mortgages are packed into mortgage-backed securities or MBS. And then they sell these securities to investors. They're considered to be as safe as treasury bonds. Mortgage-backed securities sort of became one of the Fed's biggest investments. The Federal Reserve started to buy them actively after the 2008 crisis and then during the pandemic. When investors buy these securities, they inject more money into Fannie Mae and Freddie Mac so they can buy more loans from the banks, giving them the opportunity to lend more money to Americans. This system gives more liquidity and stability to the U.S. housing market. So on one side, we have the conventional mortgages, right? Those that are backed by Fannie Mae and Freddie Mac. And on the other side, we have the so-called popular FHA loans, which are backed by the Federal Housing Administration. On the down payment side, conventional mortgages request a minimum of 3% as a down payment. Now, on the FHA side, the requirements are a little bit higher, and they require a 3.5%. Regarding credit, on the conventional side, they require you to have a minimum FICO of 620. But then on the FHA side, the requirements are a little bit more flexible. And you can actually get into the program with a FICO of 580. However, you can go even lower if you put a down payment of 10% or above. And when you do that, you can actually get into the program with a minimum FICO of 500. So everything seems great so far. But here's where things get interesting. These mortgages have a limit in terms of how much money you can get. Let me show you. So on the conventional side, you get a limit of generally, right? So for most areas, that's the maximum amount you're going to be able to get on a loan for you to buy a house. However, if you reside or you're looking to buy in an area where the cost of living is high, so let's say, for example, New York City, San Francisco, or even LA, the limits can be a bit higher. And in this case, you have a maximum limit of 4 single-family homes in high-cost areas. This means that if you saw one of those beautiful houses for $1.5 million, you have to forget about buying it with a 3% down payment because you would just simply not qualify. Now, on the FHA side, the limits are actually lower for general areas, so to speak, right? So the maximum amount that an FHA loan can give you. Now, if you happen to live in an area where the cost of living is quite high, so let's say, for example, New York, San Francisco, LA, the limit is actually the same for those type of areas. what does this mean for you? Fannie Mae introducing a 5% down payment. Okay, so let's just take a look into this. As part of the ongoing commitment to support affordable housing, Fannie Mae is introducing a 5% down payment option for multifamily homes. What do you need to know about this? Well, here are some key points that I want to highlight for you. So this is a new policy, and it will start the weekend after November 18, 2023. Fannie Mae will allow a 5% down payment for owner-occupied 2, 3, and 4 unit homes, meaning owner-occupied, meaning you need to live there, all right? So there is an investment property, and that's solely for investment purposes, meaning you rent it out to your tenants, you don't live there, and owner-occupied means you have to live there. So this program is available for those buyers who are looking to buy a 2-family home, 3-family home, or even a 4-family home. But the requirement is that you need to reside in one of those units. And that's actually a major policy change from the previous requirements of 15 to 25% down payment for such properties. The second point was the implication for buyers. So this policy change significantly reduces the upfront cash needed for multifamily home buyers. Yes, indeed, it does, making it easier for individuals to purchase multifamily homes while collecting rent and building landlord experience. The third point, low qualification with rental income. So even first-time home buyers can use the rental income from the 2 to 4 unit property to help them qualify for the loan, provided they have a current housing expense. Future rental income less a 25% vacancy factor can be used to qualify, especially beneficial in the context of high home prices and mortgage rates. So what's the motivation for doing this? What's in it for them? Well, Fannie Mae aims to support access to credit and affordable rental housing, especially with rising rents and mortgage rates. By allowing lower down payments, the agency facilitates creative and alternative ways for home buyers to afford a home. So what are the benefits for you, right? So here they're listed out. One, house hacking, right? It's a well-known term, and it has been a fantastic strategy for you, especially with housing prices soaring in all markets. So for those who don't know what house hacking means, it just simply means buying a property and renting it out units. It could be a bedroom, it could be an office, it could be a garage, or it can be another unit within the property that you buy. That's what house hacking means. In terms of down payment requirements, well, with the new loan-to-value ratios, the LTV, borrowers will only need to put down a 5%. They present additional income sources as a stepping stone into landlordship for first-time home buyers while living on the premises. The next benefit is that it is addressing high housing costs, and this policy provides a valuable advantage to buyers struggling with high housing costs across all regions. The fifth benefit is that it will benefit you directly, the owner-occupant landlord. And this policy shift represents a significant opportunity to reduce mortgage payments by leveraging rental income. You're going to be able to use your rental income in your own home, which is amazing. The next point is that it is applicable nationwide. So this policy, it will be available in all 50 states. And another benefit is that it will contribute to the rise of multi-generational living, meaning a property available for multiple generations. So you got the grandparents living on one floor, then the parents living on the other one, and then the kids living on the other one. That's great. That's awesome. Multiple incomes contributing towards affordability, right? Try focusing on factors that impact your mortgage interest rate, such as your credit score. In this channel, we talked a lot about how to achieve a healthy credit score. So if you want to get more information about that, feel free to check this video after you're done with this episode. Generally speaking, a credit above 720 will open more doors for lower mortgage interest rates, helping you save thousands of dollars in interest. The next essential factor you should consider is your down payment. It commonly ranges from 3 to 20% of the purchase price. The amount of the down payment matters because you might get additional expenses. For example, if you put less than 20% down on a conventional loan, you might need to pay for a private mortgage insurance, PMI, which can be added to your monthly payment. In this case, we're talking about a conventional loan, which means a loan that the government doesn't back. But if you get qualified for some home ownership assistance program, the required down payment might be different for you. For example, the Federal Housing Administration, or FHA loans, normally have a 3.5% down payment requirement. At the same time, VA and USDA loans might not require a down payment at all. VA loans are available to U.S. military veterans, active service members, and their families, while USDA loans are backed by the U.S. Department of Agriculture to stimulate homeownership in rural areas nationwide. So the best option is to see if you qualify for any of these programs. But if you end up getting a conventional loan with a down payment of 20% or above, consider different down payments to see how you can reduce your housing cost. There are 3 other essential concepts you should consider to get the best deal. Those are loan type, loan term, and loan amount. Now, let's see how each of them influences your mortgage rates. First, let's take a look at the loan type. Basically, you can have a fixed rate and an adjustable rate. Of course, adjustable rate mortgages generally offer lower introductory rates compared to fixed rate mortgages. Yet, those rates will likely change after 5, 7, or 10 years of the initial fixed rate period. So you won't be able to lock in the lower rate you took years ago. It might still be fine if the rates don't fluctuate much or even decrease. But if they do go up, you might end up paying much more than expected at the beginning. Whereas the fixed rate normally allows you to refinance if the rates get significantly lower. You can also bail out of an adjustable rate mortgage and switch over to a fixed rate by refinancing your existing loan. Remember that refinancing is considered applying for a new mortgage. Therefore, you will have to pay for closing costs again, which are usually 2 to 5% of the new loan. The next factor is the loan term. Obviously, 30-year fixed-rate mortgages are some of the most popular ones, but in some cases, you can consider getting a 15-year mortgage. On average, an interest rate is always from 0.5 to 1% lower for a 15-year mortgage. And over the loan lifetime, you will have some significant savings compared to the 30-year mortgage. Let's see an estimation to give you a clearer picture. Let's say, for example, you're getting a $300,000 house and making a 20% down payment, which is the equivalent of $60,000. If you get a 30-year fixed-rate mortgage at 6.71%, which, according to Freddie Mac, is the average as of June 2023, your mortgage payment will equal slightly over $1,850. This way, you will pay more than $318,000 in mortgage interest over the course of the 30-year mortgage. Now, let's see what happens if we take a 15-year fixed-rate mortgage. First, the interest rates will be a bit lower. Again, according to Freddie Mac, the average is now at 6.07%. We see here that the monthly payment rose significantly, but the mortgage interest is more than 2 times lower. Of course, now the 15-year loan looks much more appealing, but remember that you should only consider shorter loans only if you are sure that you will have enough income to cover living expenses, have savings, or put some money away for retirement. For those looking to get a custom calculation to help you decide whether you should go for a 15 or 30-year mortgage, check out this episode after you're done with this one. The loan amount is another essential factor you should take into account. Rates on unusually small mortgages, like $50,000, for example, are often higher than the average ones. This happens because they're less profitable to the lender, so they compensate for that by charging higher interest rates. On the other hand, jumbo mortgages also tend to have higher interest rates because of higher risk. In 2023, the Federal Housing Finance Agency raised the maximum conforming loan limit for a single-family property to over $720,000. In certain high-cost areas, this limit is now $1 million. A conforming loan is one that meets Fannie Mae and Freddie Mac guidelines. All these details might be overwhelming, but they can help you a lot when buying a house and cutting the cost of your monthly payments. So remember that whatever the news is, panic is the worst enemy of good decisions. And more often than not, things turn out to be better than we think. It is also much easier to navigate through any events if you have a better understanding of finances and markets. For this, we created this free webinar to teach you how to invest in real estate the right way. Here's the link down below, and I will see you in the webinar. Take care. Bye-bye.